Kevin, good to have you back on the program. The past 2 months has been filled with drama, right, about the bond market. What have you seen? I saw you guys did some research on the Treasury trading. What jumps out to you in the past couple weeks here?
Yeah, hey Oliver. Yeah, no, we've been watching the data very closely over the last 6 months in particular. December, obviously very volatile month, both in equities and fixed income. The Treasury market volumes really reflected that. So the market was trading 615 billion or so a day, which was a huge spike. If we look back sort of over 2018, 2017, the numbers were closer to 500 billion a day. So that's a big jump sort of from an average daily volume perspective. As we moved into 2019, things have slowed a little bit, although we're still elevated from a volume perspective. Sort of now trading about 550, 560 billion a day. So the market continues to watch the language from the Fed, and volatility seems to be volatile, I guess, which has a big impact there as well.
Now, this is interesting because sometimes, Kevin, I kind of like follow this logic of like volume confirmation. I don't know if it really means anything, but I look to see on some of the more interesting days of the market activity, whether it's stocks, whether it's bonds, if there's big volume behind these moves. What does it tell you that we've actually had the most volume? It sounds like to me was before we had this inversion event. It seems like that's what I just heard. The Treasury volume was actually bigger earlier on in the year.
Yeah, so I mean, there was uncertainty, and it feels like we're in a market, and we have been for quite some time, where so many people are waiting for something to go wrong. So every time there is news, there's a sharp reaction, a very quick repositioning, which is driving up volumes. Sort of as you pointed out in the graphic, dealer inventories are also way up from where they were earlier in 2018. They've sort of declined a little bit as we've been gone through the first quarter of 2019, but still elevated. So dealers are sort of holding treasuries. And there's a lot of reasons for that, why that could be, but there is certainly a continued positioning and repositioning based on expectations of inflation, of what the Fed's going to do, and whether or not the bull market that we've been in for about a decade now will continue, or some big cataclysmic event will take us out of that and move us in the other direction.
I'm curious if there's any insight from your perspective on where the Treasury is being held. I'd see in your report about levels at dealers now at about the same level compared to before Christmas of last year. We know what was going on then. It was a pretty wild time because there's a lot of speculation right now, Kevin, of all right, should we really take what's happening in the bond market with a grain of salt? If it's just foreign buyers who can't get yield in their own market, maybe it's not a real harbinger of doom. It's a whole debate, but what do you see in terms of who's actually buying and where these bonds are going? Any insight as to the reason for these purchases?
Yeah, I mean, you said that right. I mean, if we look at, for instance, if you look at the trade war with China, that could certainly be playing a part, whether China needs to buy or sell debt, depending on what the news of the day is. So there's certainly quite a bit of that. And then if you look at volumes, volumes can reflect a whole host of things, and it might not even have to do with the dealers or long-term investors. There's certainly a lot of sort of principal trading activity that goes on around market volatility, and they contribute a tremendous amount to the sort of average daily volume on any given day, again, which is more about short-term activity than it is about sort of long-term investment trends. And the sort of inverted yield curve, history sort of has shown pretty clearly what that often leads to. Although again, the market today is very different than it was 10 years ago in terms of players and dealers' ability to commit capital, and just the rules of the markets, and increasingly of the global economy. We've seen so many changes over the last even just 2 or 3 years.
Do you pay attention to what happens at some of the auctions this week? We were talking about the 2-year and the 5 because they came right on the back of some of the bond market activity, and there was a pretty big demand from non-dealers, at least for the 2-year note auction. And I'm just curious if what you see in terms of the types of buyers for the market tells anything, because again, I just want to point to the number you guys have with inventories still 3 times greater than they were at the beginning of 2019.
Yeah, no, so dealers are holding more, but I think, what the bigger longer term trend is the, asset managers are buying and holding much more so than they ever have. There could be some impact of more passive investing there as well, where they need to sort of keep a continuous duration to keep that ETF in line with the index, for instance. But the trend since the financial crisis, almost 10 years now, is more and more that the big asset managers are buying and holding fixed income debt, and not sort of trading it as frequently. And there's, I think some of that is due to liquidity in the market, where the dealers can't commit as much capital as they once could, and some of that is just sort of a change in demand of sort of the end investor, whether that be the institutional investors or retail, where people are, even though the market has been so good for so long, people continue to be nervous. There are still a lot of people out there that lost a lot of money in 2008, 2009, and they continue to be cautious. And obviously, right, Treasuries are the place to be if you are cautious.
Yeah. Okay. I want to talk a little equities with you while we got you, Kevin. There's an interesting story that seemed that was up your alley that I saw that a lot of people were talking about in terms of liquidity in the futures in the S&P 500 futures market. The Wall Street Journal had an article. The folks at Morgan Stanley, I think, did some of the research behind this, showing that liquidity had thinned out, not just during the sell-off last year, but that didn't really turn around. What does that mean to you? What do you think about this?
Yeah, I mean, it's interesting is that, those statistics usually do correlate with volatility, or I'm sorry, inversely correlate with volatility. Although volatility remains relatively low, it's, again, sort of spiked here and there, but the trend they showed looked to be a little bit more long-term. What that signifies is a little bit hard to tell, again, because the market has changed so much since those statistics that they have back there in 2008, 2009. For instance, the swaps market is a lot more accessible today, right, than it was 10 years ago, because there's much more structure and regulation and standardization there, right? So swaps could be coming into play to get some of the exposure that otherwise would have been had with futures. ETFs provide much more so of an alternative today than they had 10 years ago as well, right? And we see that in equities and in fixed income, where ETFs can be used, where otherwise maybe a derivative would have been used. And then lastly, and this maybe is more directly correlated to this move, is the principal trading firms that do provide quite a lot of the liquidity in these futures markets. There are less of them today. There's been a lot of consolidation in that sector. Which means that there's going to just be smaller size at the top of the book than there had been in the past 5 or 10 years ago, when there were many, many more firms that were out trading very heavily in these markets. It's
interesting because we've talked, Kevin. I kind of like to do like the post sell-off check-in with you to see if anything broke. If we bring up the chart again, I noticed that the liquidity also thinned out during a few other of the major, moments of I don't know, crisis or sell-offs. Late 2015, early 16 were when this metric that JP Morgan put together. Sorry, I misspoke earlier. Morgan Stanley. JP Morgan put together. So that dipped in that sell-off there as well. So if things, didn't break, which right now obviously things seem to be working okay. Yes, this is a little bit low. The argument to me still seems to be that, look, yes, the nature of the market has changed. We had the worst December since the Depression, followed by like the best quarter in 10 years. Maybe things moved more quickly, but not in a way that derails where they would have gone over a longer period of time. What do you think?
Yeah, that's probably right. I mean, the algorithms just get more cautious when the markets get volatile, right? They don't know what to expect. They're not willing to commit, a certain amount of capital at that given price, at any moment in time. People can look to blame, and you and I have talked about high frequency trading quite a lot. People look to, blame the traders on some of these quick moves. The reality is the same behavior, occurred 20, 30, 40 years ago, long before we were looking at these markets. It just happened a little bit slower. But, the deals would back off on their bids, before it was highly electronic, and now the computers do it more quickly. But things get volatile, market makers, back away a little bit until they can understand exactly what's going on. And in this case, it seems not that they are leaving the market, but instead that they are, that they're just diminishing their bid a bit.
Yeah. All right. There we go, Kevin. And you guys' auto lighting knows when the block time is up. Hey, great stuff, Kevin McPartland. Awesome conversation as always. Really useful. Thank you.